All right, well, inflation is cooling. The consumer price index rising 3% in June from a year ago, the smallest annual gain in more than 2 years. For more on what this means for the market, we want to bring in Eric Freedman, U.S. Bank Asset Management Chief Investment Officer. Eric, it's good to see you. So it's evident here by today's market action that more and more investors are betting that maybe the Fed will be done after raising rates later this month. What do you think?
Yeah, sure. I think that's exactly right. You know, the probabilities have gone down for that September rate hike. I think if the Fed had a mulligan, which is something I need when I play golf, the space between next week's interest rate announcement and then not until the end of September, that's a long time period. There's a lot of data that's going to happen between now and then. But again, I think that today's CPI print was probably helped somewhat by what people like us look at data consider a strong base effect comparison. In other words, it was tempered somewhat by a tougher comparison period over last year. So net, it is good news. We want to see what next month looks like as well as the PCE data, but certainly heading in the right direction from the Fed's perspective.
What do you think is the bar for a second hike? I mean, certainly you could argue that September may be off the table, but there's still those out there who say there could be another rate hike coming by year end.
Yeah, Akiko, I think that's a great observation. And really, I guess the phrase that we would use is how much progress is there towards the quote unquote last mile of not just the Fed, but the Bank of England, the European Central Bank, that all have these 2% stated inflation targets. And we're still a long way from 2%. The move from 9%, where we printed last June, to 3%, where we printed this morning, I mean, that's a lot of progress. But that last mile between 3 to 2, there's still some real estate between now and there. So bottom line is that we think that anything that picks up higher in terms of like either a CPI or tomorrow's PPI data, but also PCE, again, you have to keep in mind that that's what the Fed cares most about, is this PCE gauge, as well as progress on what they're calling super core, which is, again, a very, let's call it, specific subset of inflation. So anything that suggests that, look, September should be back on the table, we think the Fed is going to have a bias for higher for longer as opposed to looking to cut rates. So the bar is not that high, but we'll have more data between now and then to really assess.
Eric, when you take into account what's happening within the labor market, right, and this points to wages keep increasing because the labor market remains very tight. If we do see 2 more hikes here from the Fed, how big of an impact, or what do you see the employment picture looking like as we get closer to the end of the year?
Yeah, Sean, I mean, one of the things that's really interesting as you looked at the data this morning was the increase in real wages. That's something that actually did tick a little more modestly last month, but really picked up in this latest inflation data. So bottom line is that we still think that the rumors of the demise of the consumer, the rumors of the demise of the American worker are really overstated, and the consumer is just hanging in there. So there's still a shortage of labor. That's true across any small business survey you look at, even though we did have some decent data yesterday from small businesses, that they're just having a tough time keeping people in chairs. So we still think the bias is for an ongoing healthy labor market. Our U.S. Bank economics team thinks it will avoid a recession because of the strength of the labor market and the consumer. So we still are pretty bullish on prospects ahead.
Eric, you've got the heart of earnings season kicking off tomorrow. PepsiCo and Delta leading the reports there, but we've got some big banks reporting on Friday as well. The expectation, or you could argue the bar, is very low going into this earnings season. What are you expecting in terms of surprises to the upside?
Yeah, Kiko, if you look at the bar, to your point, it's pretty low. There's a minus 7.2% expectation for earnings growth this quarter, and actually a 3% revenue decline. So investors are already set up for some level of a contraction on the economic impulse front. So where we think there could be some surprises is really twofold. Number one is news on CapEx from companies. That's going to be, again, a key marker for the technology sector, which, of course, has been up 40% from a trough to peak perspective, given today's move. That's a material move. It has to be backed up by CapEx. We think there's going to be ongoing spending in things like, obviously, artificial intelligence, big data, communication services. So the first upside surprise we think may be on CapEx. The second is the factors that really drive consumer spending. We think there could be some upside surprises there. Again, it's almost been this like monolithic painting of the consumer picture. There are a lot of subsets within consumers that are doing really well. There are some concerns that perhaps lower income consumers are going to hit a headwind with respect to wage growth, probably slowing down a little bit. But if you look at other cohorts, there still is a lot of momentum. So bottom line is that we think CapEx may be a bit better than expectations. We also think the consumer will likely be more resilient than Wall Street is perhaps giving it credit for right now.
So then, Eric, what does that tell us just about the pricing power that companies still do have? If consumers are out there buying, whether it's on goods, whether it's on experiences, then do they have a little bit more room to continue to raise their prices and pass down those costs to the consumer?
Yeah, Sean, I think it's a really important point and an observation you make. I'd say two thoughts. One would be there's some evidence that we've seen of consumer product companies, consumer staples in particular, probably towards the end of their pass-through cycle, just given what the consumers already endured. That being said, on the experience side, whether you look at hospitality, whether you look at travel and experiences, to your point, there still is that ongoing bid, not just because we're in the summer months and people take holidays, but there seems to be an ongoing demand for those experiential type of sectors to get some upside surprises in terms of pricing. So I think, certain goods are probably at the latter end, if you will, of their pricing power. But the experiences side, and also, again, scarce tech, it's maybe, circular reasoning, but scarce tech continues to have pricing power. The things that again, are going to make companies bigger, stronger, faster, they keep having the advantage that other companies don't. So those are, again, probably some gradients of differences across sectors, but we certainly think there's some pricing power left from the supply side.
So, Eric, let's talk strategy, where investors should be putting their money. Talk to me about these catch-up trades you're eyeing.
Yeah, some of the things, Akiko, that we're really focused on are not so much on technology. We came into 2021 fairly bullish. That worked out. 2022, we pivoted to be a bit more bearish. That helped. And we were a little too bearish to start out this year. We've been adding to equity exposure throughout the course of this year, both domestically and internationally, which has worked quite well. I think the thing that's next as a test for markets will be what happens with these quote unquote catch-up trades. When we say catch-up trades, it's the things that have really not been participating in what has been an otherwise narrowly led domestic equity market. So things like U.S. small cap, U.S. mid cap, those are areas that have not performed as well. The relative spread between small cap to large cap is about as wide as it's been in the past 5 years. We think that could be potentially interesting. Other things like real estate and energy. Again, real estate, we all know the issues out there in the office space and other parts of the real estate landscape. There's also lots of good things happening across areas like multifamily that again, when you have some yield component to a total return like you have in real estate, that could actually garner some interest. Finally, energy is an area that, of course, was the beloved sector last year that has been absolutely nowhere so far this year. That's a spot that, again, we think there is some dividend. There's some interest in returning cash to shareholders. And if we see a contraction in bond yields, we'd expect that energy could actually start to perform fairly well, including areas like midstream energy, which investors can certainly get some exposure to. So that we think is the next frontier for markets. Not so much what happens with tech. Again, we're constructive on tech. We actually think the next leg are some of these catch-up trades, mid-cap, small cap, real estate, as well as energy. Those are spots to pay attention to.
Eric, what about utilities? As some of those inflationary pressures they are easing right now. If they do continue to ease, could that provide a little bit of a catalyst there for that sector?
Sean, it certainly could. It's a great business model. You're talking about regulated businesses that have, generally speaking, some level of inflation protection embedded in their pricing. That's something that again, even if inflation eases a bit, there's still the need for a hedge, if you will. And so utilities can provide some level of just inherent regulated pricing power in what they do. Again, they do return cash to shareholders, as you mentioned. And so one of the things that you were rightfully pointing out the prior segments is what's happening with interest rates. We have to look at where yields are right now. They peaked above 4% last week, and a contraction in interest rates is very good for dividend paying entities. And that's true for utilities. It's true for infrastructure, true for energy as well. And so that could be another leg, if you will, to that stool with utilities. Again, not necessarily the most economically sensitive sector, but does provide some really nice cash cushion for investors. And as yields contract, certainly could get another part of that story as well.
Eric Freedman, U.S. Bank Asset Management Group CIO. It's good to talk to you. Really appreciate the time.